Your favorite burrito bowl spot, Chipotle, reported Q3 earnings on October the 25th, and so far we've seen an 11% decline in the stock price. If we take a longer dated viewpoint, we are down 27% from the highs in 2021. So with a business like Chipotle, with a strong customer base and growing fundamentals, is this the pullback investors have been waiting for to pick up shares at a slight discount, or do we expect this stock to go lower for longer? Make sure to stick around because we'll answer all those questions on today's episode. How's it going? Welcome to Everything Investing. I hope you're having a great day. As always, we will start this video off with an in-depth analysis into the fundamentals of this business, top line, bottom line, balance sheet, cash flows, etc. Finally, we'll conclude with an evaluation of this business using our intrinsic value calculator, which will identify the buying opportunities for Chipotle. And if you enjoy this type of content, make sure to smash that subscribe button because we do post on here regularly analyzing the various businesses that you are interested in. And if you do end up enjoying this video, make sure to like, comment, and without further ado, let's jump into it. Okay, so we will start with our CEO's comments here. This one is relatively brief as the CEO just let investors know that the third quarter confirms their brand and value proposition remains strong, even during the challenging economic environment that we're in right now. And even though consumers are not spending as much, they're still focused on running a great business and delivering excellent customer and employee experiences. Okay, we can see here this is a business that has been able to grow their revenues year over year on an extremely consistent basis. And for the most part, bottom line also has grown. We have had some slowdowns here, but overall we've seen growth. And if we compare the performance to the S&P 500 and the restaurants within the S&P 500, we can see Chipotle has massively outperformed those stocks, which is driving total returns. And once again, from this quarter, we've also seen some strong results. They produced about $2.2 billion in revenues this quarter, a 13% increase compared to the same period a year ago. And it's the result of a 7.6% increase in comparable restaurant store sales. Remember, that is the key metric that we're looking for when it comes to restaurant and retail businesses. How much are those same stores selling, on a year over year basis? Because we know revenues will increase when they open restaurants. So it's important to note what's happening with those older ones that are still open. And we can really see here another example of this where they opened 43 new restaurants. And that's also been a contributor to the increases they've seen in restaurant sales, their new improved margins and returns. Their food and beverage packaging costs for the third quarter were about 30% of their total revenue. That's actually a decrease of 50 basis points as well compared to the same period a year ago. That's all the while fighting, inflationary pressures here on their ingredients. Now let's take a look at how all this impacted their fundamentals. Okay, food and beverage revenue is $2.2 billion. They also have delivery service revenue. That's about $17 million. Ultimately, revenues of $2.2 billion. Add in our operating expenses here, and we're left with $336 million in income from operations off the basis of total operating expenses of $1.8 billion. That accounted for about 85% of revenues. Now, if we compare this to last year, their costs were accounting for about 87, almost 88% of revenue. So when we're able to increase revenues while also simultaneously decreasing expenses, that's an investor's dream right there. And so we had a positive impact here on fundamentals. Now let's jump into our balance sheet. We can see they have about $366 million in cash. Surprisingly, no debt at all on the balance sheet. So once again, very clean here from a liquidity point of view. Now let's look at this from the cash flow perspective. We have about $921 million that are produced from operating this business. We deduct our capex figure here of $335 million. We're left with about $586 million in free cash flow to reward shareholders. What exactly is a business like Chipotle doing with that? Well, they're actually just using that to buy back some stock. All right. And so from the 9 months perspective figure here, they're already at about $864 million in income from operations. When we compare that to their historical results just last year, they had about $804 million by the end of 2021. So when we get over to our calculator here, we can reasonably estimate that they'll have about $1 billion in operating income by the end of the year, leading to further growth of their fundamentals. And if we require a 10% return, they are not paying a dividend currently. And I mean, look at this 5-year revenue EPS growth rates of 97%. I'm not even going to use these numbers in our calculations because that's just too lofty, but if on a reasonable basis they can stick to their revenue growth rates of 14% for the first 5 years, that drops down to about 10% for the 5 to 10 years after that. On a 45 PE like they're currently trading at, this stock would be worth about 1.9K. Right now we're sitting at about 1.4K, so a considerable amount of upside from the normal case scenario. Now, in the very best case scenario where we see a very strong impact from a rebound in the economy, there's more consumer spending like they were saying there's been a decline of, and if we estimate that on a reasonable reasonable basis and less inflationary costs, that they can grow at about 25%, let's just say, for the first 5 years. That drops down to only 15% for the 5 to 10 years after that. On again, a 45 PE, yeah, the stock would be about 3.6 grand, or in other words, $101 billion in market cap. Right now, this is only trading at a market cap of $39 billion. Okay, and in the very worst case scenario, where inflation really impacts the cost of their goods and their ingredients, their margins are impacted, there's more tightening for consumer spending. Let's assume that they can only grow at, let's just say 0% for the next 5 years. That stays constant actually for the next 5 years after that. And let's assume the PE drops down to about a 35. Yeah, the stock would only be worth about $500. Now that is the very, very worst case scenario. And if the stock price did start to decline at these prices, yeah, the terminal PE would actually increase. So let's assume that it would be like 55 or something. Yeah, 841 actually sounds a little more realistic. But yeah, for a stock like Chipotle, as you can see, I mean, we've seen nothing but compounded growth year over year over year with this stock, from back at $1 per share all the way up to now highs of $1,800 per share. So we've seen this stock explode before, and it's not unrealistic for them to get back to those highs of $1,800 again once we do see a rebound in the economy. And that is just in our normal case. That's not assuming the best case scenario. There is a reason why the stock is only down about 25%, while the rest of the market is actually down way more than 25%. So clearly there's some investors that are still sticking around in this stock. They like what they're seeing, especially with the increases to their margins, decreases to operating expenses, and then increases to the revenues. I mean, it's always a great thing to see from any business. But let me know your thoughts in the comment box below. I'd love to hear back and have a discussion. That's just my analysis. If you've enjoyed it to this point, make sure to like, subscribe, comment, and I'll catch you on the next one.